Be extremely careful when investing in stock. Investing in stocks can be exciting, but it's no walk in the park. In fact, it's a risky business. There's a lot of hype around stock investing, especially with success stories like Tesla and Apple. But what we don't often hear are the stories of people who lose big. Stock investing isn't a guaranteed path to wealth. In fact, without careful planning and research, it could be a shortcut to losing money. Let's get into why caution should be your best friend in this journey. Let's get one thing straight. The stock market is volatile. One moment it's all green, and the next it's a sea of red. Market volatility can be triggered by countless factors, from political events to economic reports. Remember the financial crash of 2008? Or how about the stock market roller coaster ride during the COVID-19 pandemic? These events serve as harsh reminders that no matter how smart your investment strategy may seem, the market can always surprise you. But it's not just external events. There's a hidden enemy lurking in every investor's mind: behavioral biases. The fear of missing out, or FOMO, can lead you to buy stocks at their peak, but panic can make you sell at rock bottom prices. The stock market thrives on emotion, and it's crucial to keep yours in check. You see, no one can control the stock market. What you can control is how you react to it. So before diving in, always remind yourself investing in stocks means embracing unpredictability. The goal is not to avoid risk, but to manage it effectively. Let's take a closer look at some of the common mistakes beginners make and how you can avoid them. One of the biggest mistakes new investors make is chasing trends. This happens when you hear about a hot stock that's been surging and you decide to jump in. We've all seen the headlines: stocks that seem unstoppable, fueled by social media and hype. Remember the GameStop frenzy? It captured the world's attention as retail investors drove the price up to insane levels. But what happened next? The price collapsed, and many latecomers who bought at the peak lost big. Chasing trends might make you feel like you're riding the wave, but more often than not, you're left wiping out. Then there's the temptation to time the market. You think you can predict when the market will go up or down, right? Wrong. Timing the market is like trying to catch a falling knife. You're more likely to get hurt than come out ahead. Even professional investors with years of experience struggle to time the market accurately. Studies have shown that even missing out on just a few of the best trading days each year can significantly reduce your returns. Instead of trying to time the market, focus on staying in the market and letting your investments grow over time. Another common mistake is emotional decision-making. It's easy to get caught up in the excitement when your stocks are up or feel overwhelmed by fear when they're down. But making decisions based on emotion rather than logic can lead to costly mistakes. For example, during the 2008 financial crisis, many investors sold off their portfolios in a panic. Those who stayed invested eventually saw their portfolios recover and grow. Those who sold at the bottom locked in their losses and missed out on the recovery. The market can be irrational in the short term, but history has shown that it tends to reward patience and long-term thinking. And let's not forget the obsession with short-term gains. Many new investors get caught up in the excitement of quick profits, but in doing so, they lose sight of the bigger picture. Stock investing is a marathon, not a sprint. Trying to get rich quickly in the stock market often leads to poor decision-making and increased risk. Chasing short-term gains might give you an adrenaline rush, but it can also lead to burnout and losses. Instead of focusing on the day-to-day fluctuations, adopt a long-term perspective. This approach not only reduces stress, but also increases your chances of success. The importance of research and education. Here are some hard truths. You can't succeed in the stock market without doing your homework. Research is your best friend when it comes to making informed decisions. That means digging into a company's financials, understanding its industry, and keeping up with market trends. Every stock has a story. What's driving the company's growth? What risks does it face? Is the stock overvalued or does it have room to grow? These are the questions you need to ask before hitting that buy button. You wouldn't buy a house without inspecting it first, so why would you buy stock without knowing the full picture? But research isn't a one-time thing. The stock market is constantly evolving, and so should your knowledge. So make it a habit to educate yourself. Read books, subscribe to this channel for more educational videos, and follow reliable financial news. The more you know, the better your chances of making sound investments. And remember, it's okay to ask questions. Investing isn't about being a lone wolf. Join communities, discuss strategies with other investors, and never stop learning. Diversification as a key strategy. Ever heard the saying, don't put all your eggs in one basket? Well, that's the essence of diversification. When you diversify your investments, you spread your risk across different assets. This way, if one investment tanks, the others can help cushion the blow. For example, let's say you invested all your money in tech stocks. If the tech sector experiences a downturn, your entire portfolio could be in trouble. But if you had diversified your investments across different sectors like healthcare, consumer goods, and real estate, only a portion of your portfolio would be affected. Diversification doesn't just apply to stocks. Bonds, real estate, commodities, and even cash can play a role in balancing your portfolio. These assets tend to behave differently than stocks, providing stability during market downturns. For example, when stock prices fall, bond prices often rise, offering a cushion against losses. Diversification isn't just about reducing risk, it's all about increasing your chances of success. By investing in a variety of assets, you're more likely to benefit from growth in different areas of the market. This approach helps smooth out the ups and downs, making your investment journey less stressful and more rewarding over the long term. When it comes to investing in stocks, it's essential to have the right mindset. Are you in it for the long haul, or are you trying to make a quick buck? The answer can make or break your investment strategy. Short-term investing can be thrilling. The adrenaline rush of watching your stock skyrocket is unmatched, but what goes up fast can come down even faster. That's why focusing on short-term gains can be dangerous. You're more likely to get burned by market corrections or sudden downturns. On the other hand, long-term investing is like planting a tree. It takes time, patience, and care, but eventually it bears fruit. By holding on to your investments for the long term, you can ride out the market's ups and downs and benefit from compound growth. So before you invest, ask yourself, are you looking for instant gratification, or are you willing to wait for lasting rewards? Patience is key. Now let's talk about protection, specifically protecting your capital. Even the best investors make mistakes, but the difference between winning and losing often comes down to minimizing losses. One way to protect yourself is by using stop-loss orders. A stop-loss order automatically sells your stock if it drops to a certain price, helping you avoid even bigger losses. But don't just rely on stop losses. You need to know when to cut your losses manually. It's hard to admit when an investment isn't working out, but sometimes the best decision is to walk away before things get worse. Think of it like this. If you find yourself in a sinking boat, do you try to fix it while it's going down, or do you jump into a lifeboat? Sometimes cutting your losses is the lifeboat you need to save your capital. Another way to protect your capital is by incorporating safer investment strategies into your portfolio. Diversifying your bonds, real estate, or even cash equivalents can provide stability. Stocks are exciting, but they shouldn't be the only asset in your portfolio. A well-balanced investment strategy includes a mix of high-risk and low-risk assets, ensuring that even if your stocks take a hit, your overall wealth remains intact. Let's face it, the stock market can be overwhelming, and while doing your research is crucial, there's no shame in seeking professional help. Financial advisors can provide guidance tailored to your specific goals and risk tolerance. Think of a financial advisor as your coach. They can help you craft a winning strategy and avoid common pitfalls. However, it's essential to choose your advisor wisely. Make sure they have the necessary credentials and ratings that their advice aligns with your financial goals. Balancing is key. While advisors can be helpful, you don't want to become overly reliant on them. Learning to manage your investments on your own is empowering. After all, no one will care about your money as much as you do. To wrap it up, investing in stocks can be a fantastic way to build wealth, but it comes with significant risks. From market volatility to emotional decision-making, there are countless pitfalls that can derail your investment journey. The key takeaway? Be extremely careful. Take the time to research, diversify your portfolio, protect your capital, and seek professional advice when needed. Stock investing isn't about getting rich overnight. It's about building long-term wealth while managing the risks along the way. Remember, successful investing requires patience, discipline, and a healthy dose of caution. So as you venture into the world of stocks, do so with your eyes wide open and your strategy well thought out. With the right approach, you can achieve your financial goals without falling into the many traps that the market can set. Happy investing, and see you in the next video.